Hi,
It's yours.
everyone. Thanks for tuning in today. I am Melissa Mueller. I am the current president and chief investment strategist for the Smile Fund. And moving on to our agenda for today, you will be hearing a performance update from myself, an economic update from Jacob, a risk management update from Liam, and then we're going to move on to a stock pitch and industrials from Drew, a REIT stock pitch from Joel, and we'll finish it off with a sector update in information technology from Stephen. Starting off with the traditional fund's performance, the fund had a year-to-date performance ending August 31st, 2020 of 21.7%, and our benchmark, the S&P 500, had a total return of 9.75. This 11.5% outperformance was mainly driven by our selection effect, but I'm actually going to let Liam talk more on that during his risk management update. Moving on to the fund's weightings versus the S&P 500, I want to touch a little bit on our allocation and our plans for it. Starting with consumer discretionary, we plan to go overweight in this sector as we had a negative allocation effect due to being underweight. We also plan to trim a little bit in consumer staples. This does not mean we're going to be in line or underweight. We still plan to be overweight. We just think reallocating a little bit of this money to another sector that we believe is going to generate better returns is smart. And regarding financials, we plan to rebalance it, but again, I'm going to let Jacob talk about it during his macroeconomic update. The fund then wants to increase our weighting in industrials, but remained underweight versus the market. We want to gain exposure to cyber defense in the industrial sector. Information technology was overall our best performing sector. It's overall the best performing for S&P and for the Smile Fund. And we want to increase our weighting to become overweight in the sector because we see many long-term trends in this area. And again, this is going to be a big topic that Jacob and then Stephen talk about in their presentation. So I'm just going to keep a high-level overview on this. Lastly, for utility sector, we plan to move underweight position. Essential utilities has been one of our worst performers, and we would rather focus and expand our research on companies who are investing in renewable energy production, storage, etc. Now, many of the trends I touched on and the ones Jacob will also talk on tie into many of our plans for the strategic fund too. If we move to the strategic fund, you can see that we are outperforming our weighted benchmark by 3.7%. Our weighted benchmark consists of the S&P 500, S&P 400, the Russell 2000, and the MSCI EAFE. The outperformance of this was mainly driven to us having a heavily weighted position in the S&P 500. We have decreased our weightings in a few of our ETFs as we have entered into a few new positions. The fund has decided to enter in the proof point because we believe that cybersecurity is more of a necessity now than ever. Even with difficult economic situations, cybersecurity is needed as the shift to everything becoming more digital continues. And we believe proof point is a quality reopening play as work from home is a long-term trend in this foreseeable future. In addition, there still are rising attack volumes. We have also entered Inphi as they provide high-speed analog and mixed-signal semiconductor solutions for cloud markets and communications. Essentially, Inphi helps transport big data quickly, so they benefit from the work-at-home dynamics and the more secular tailwinds such as big data centers and 5G. We entered Jabil Circuits, who is a worldwide manufacturing services company that provides electronic design, production, and productions management services. Management services consist of manufacturing, testing, configuring, assembling, and then packing or shipping also. A few of Jabil's major customers include Amazon, who is one of our top holdings, Apple, who is also one of our top holdings, Cisco Systems, GoPro, and HP. Lastly, we entered in the Ørsted, who is an offshore wind utility based in Denmark. This gives us international exposure. They have the largest capacity of installed offshore wind power globally. Growth and focus on the offshore wind business should continue to provide them with low-cost leadership in the industry. And while there are rising concerns around competition, the offshore wind business remains a niche industry with significant long-term growth and reasonably high barriers to entry in developing markets. Ørsted has multiple contracts in their pipeline and has also recently acquired a solar farm that's currently under construction in Alabama. So in addition to them being the offshore wind business leader, they have also entered the onshore wind market in the past few years and now have entered the solar market. Moving on to the small funds plan for the strategic fund, we want to double down our sector ETF weightings as our allocation in the other ETFs hindered our performance a little, and we missed the opportunity to capture the returns that this traditional fund did. After we address our allocation, we plan on reallocating more of that money out of the ETFs and into some other companies. Our approved list at the moment is still very small. There's about maybe 5 names on there. And that's because the companies we researched, we realized they're not as smart of investments as we may have initially thought after researching them and looking at their financial statements and just doing valuations on them. And that brings us to our third point of continuing to expand our research as much as we can and get as much on the approved list. You can see the few of the companies and their logos surrounding the main points, and you're actually going to hear a stock pitch about one of them today for the strategic fund. And if there's no other questions, we'll pass it on to Jacob.
Melissa, I have one if you don't mind. You made a comment about, I'm not sure I understood it. Maybe you can elaborate. Something about the ETFs hindered your ability, I think, to capture the alpha. So explain a little bit about what you mean by that, please.
Yeah, so we're in, for example, for mid-cap, our mid-cap allocation, we're split between a mid-cap growth and a mid-cap value. And then for small cap, we're in an ETF for each of the sectors. So we just want to fix those weightings as we would for the traditional fund. Just so, say we want to be more heavily weighted in small cap IT, we would allocate more money to that before we went and picked specific companies. So we want to fix the allocations within.
So you're going from a style-based ETF strategy to one that's sector-based. Is that where you feel like you missed out on an opportunity?
Yes, we've missed out sector and also cap size.
Okay.
Because for a little bit, the mid cap wasn't doing as well as the small cap or vice versa.
Okay.
All right, I'll pass it off to Jacob.
All right, my name is Jacob Snook. I'm the VP of Market Analysis, and today I'll be giving the macro update. So first, I just want to start with the COVID-19 update. New daily cases in the U.S. have decreased 49.7% from the 7-day average high in July of almost 67,000 to 34,000 about. And we believe relatively low-cost measures such as face masks, social distancing, contactless payment, all of these can limit the virus risk. And over the past 6 months, doctors have really begun to understand how to treat the virus without a vaccine. For example, doctors have realized that blood clotting was present in some fatal cases, so they began prescribing blood thinners. And additionally, there was some recent evidence that showed corticosteroids were effective in treating severe cases of the virus, reducing deaths by about 1/3, which again raises the confidence that the virus can be treated with some relatively low-cost measures while a vaccine is being developed. We also know that earlier PPE and ventilator shortages are not as prevalent. As far as reopenings and things go, we saw that places were initially hotbeds for virus surges like California, Florida, Arizona, New York are beginning to open back up. California has allowed more counties to open and move forward with restaurants opening, movie theaters, zoos, museums. And this is the same for Miami. Theme parks are reopening there. And then New York City is actually allowing indoor dining to resume at reduced capacity. So all these are good for our outlook here, just showing that we can continue in the meantime without a vaccine to continue to reopen businesses. The graph at the top right is our vaccine candidate tracker from the New York Times. It shows how many vaccine candidates are on each stage of the trial, going from left to right. Left is these earlier stages, just testing and developing the vaccine. The further right you go is, the further along in the process. And we see that 3 vaccines have made it to that approved or early limited use. The federal government has spent about $10 billion in federal funds to do this research. So it is something that we're looking at. But what we want to point out is We know that the market is sort of anticipating a very high probability that we have a vaccine by the end of the year or early next year. We know that from super forecasters from Goldman Sachs, they're saying that, you know, maybe we don't see this until mid to late 2021. So we know that there's a disconnect there. And so we expect increased volatility at each step of the way if there's any setback or failure. And we point to AstraZeneca kind of pausing those trials. Even though this is something that's familiar with vaccine development, any pause or setback will be big news, and we expect volatility there. One thing that we do want to point out is that the distribution of these vaccines will be an incredible effort from the government and major shipping companies. Some of the vaccines have to be stored at really extremely cold temperatures, as low as -80 degrees Celsius for some mRNA vaccines. And so we know that cold storage and dry ice will be needed in really massive quantities. And so we're looking at some of those areas for potential investment and how that affects distribution going forward. I say all this to say, while a vaccine is important, we're confident that the U.S. can continue to make improvements in employment and retail sales, dining, entertainment, in the meantime with maybe some continued fiscal support. And obviously that hinges on sort of resurgent cases in the virus. Here, I just want to talk a little bit about the election, our outlook, and how party influence can change our performance and ideas. Looking at the top left, we can see that based on a 60% equity, 40% fixed income portfolio using global financial data all the way back to 1860, there's not really really statistically significant difference between Democrat and Republican presidencies. 8.4% for Democrats, 8.2% for Republicans. And that's the same story with election years versus non-election years, right? A little bit different there. And even in the case of unified governments, where you have a Republican president and Republican Congress and vice versa, the returns are even shortened, right? The spread there, I mean, it's really close. And so our point here is that we're not wanting to make any sort of tactical decisions based off of how we think the election will go. But we do believe elections matter. But the point is that party control may not have a historically significant impact on market performance. So that's how we're wanting to look at things. Something that we are looking at, for example, is the possibility of contested elections. In 2000, we saw really increased volatility of the contested election between Bush and Gore, the hanging chads. And the S&P 500 fell from October to the beginning of January about 4.5%. There's a lot of uncertainty there. And with mail-in ballots to be very popular, I think this November, and some of the restrictions only being that you have to postmark ballots at November 3rd, there are some concerns there about whether votes will be counted in time and when those results will come in. So we know that there's uncertainty and maybe potential opportunity for us with that. All that being said, we look at this and we consider Biden's lead in the polls, battleground strength, and we feel it's prudent just to assess the impacts of any proposed policies there on our portfolio. Polls aren't as close as they were in 2016. Biden has some of that strength, like I said, in the battleground states. Additionally, it goes without saying, incumbents have a pretty hard time being reelected during a recession and economic hard times. Again, I understand COVID-19 has proposed a really unique set of circumstances, just wanting to kind of look at these impacts and what they could mean. First, we have environmental and climate change. We know that Biden has proposed widespread changes to the energy production. His campaign has suggested $1.7 trillion in federal investment in green technology. In addition, we expect some sort of widespread action against fracking or new federal land lease agreements for oil companies. And this supports our view on, our negative view on fossil fuels and our move to renewable energy. Going to healthcare, we know that Biden hasn't proposed a universal healthcare program like some of the more progressive in his party, but he has proposed a public option similar to Medicare. We believe there is a lot of large impacts there on drug production, pricing, through executive action, legislation. increased bargaining power with that. So maybe we begin to favor medical device companies, begin looking at the impacts on drug pricing and our drug production companies. Finally, I will say that with trade, maybe these trade relations improve. Maybe we would ease some of the uncertainties there that we see regarding tariffs and international relations. But we do believe tensions with China will remain high. Biden has spoken out against their unfair trade practices and theft of U.S. companies' technology. So we want to keep an eye on this and see how international exposure may benefit from that. Despite that, we still anticipate some of the onshoring and nearshoring that we see because of the pandemic. Going over to that right side for fiscal stimulus, we saw the gains in employment have complicated discussions in Congress for additional stimulus. The August unemployment rate declined 1.8 percentage points to 8.4%. And that additional $600 per week unemployment ended July 31st. And there's no real additional funding in that FEMA program that was signed in by President Trump that added the additional $300 per week. And so we know that some additional stimulus may be needed to sustain the consumer spending gains that we've seen and to really help small businesses, right? The PPP funding has run out for many of those. And so to continue those job gains, we want to see this fiscal stimulus and how the discussions progress. So if you want to click that next slide to go to the distribution. So here we see the percent distribution of duration of the unemployment. On that left side, we see at the very beginning the higher proportion of the less than 5 weeks, right? That's expected. And then as we move along, the 15 weeks and over gains a large portion of that distribution, over 60.1%. And the concern is that as time goes on, will they be just temporarily displaced, or will that turn into a temporary or permanent displacement that we see? And then if these benefits aren't extended through additional stimulus, how will that affect these consumers and businesses that have relied on those benefits? You can go to the next slide. Here, just to reiterate that point, we see continued claims data. Continued claims are down 46% that we saw back in April and May. But they are decreasing at a decreasing rate, right? Support of small businesses and beaten down industries may be needed just to keep these employment gains going forward. And we know that any resurgences with the virus could also threaten these gains. So here, just taking a look at the market valuations and earning expectations for certain industries and sectors, we know that companies that have performed well because of the new and accelerated trends pushed by COVID-19 really haven't been pushed only by speculation, right? We know that the market is rewarding businesses who have been strengthened as a result of the pandemic and punishing those who are really suffering. Companies who have performed well have shown higher sales growth, higher EPS growth, higher reinvestment rates, lowest levels of debt, and better margins. I mean, we understand that these valuations and multiples are high and have increased significantly, but they have the fundamentals to back that up. So if we look at the bottom left graph, EPS growth by return bucket, we see that far right column or bar there, the greater than 100% price return has really shown the best EPS growth at 50.8%. And you can look at those from left to right. That far right graph does show the point that their valuations are still stretched a little bit. Again, looking at the next 12 months P to E, those companies do see the highest P to E ratios. So I'm thinking of companies here like smaller companies, Zoom, DocuSign, Square. All these companies have provided really essential services during the pandemic that's led to the explosive growth that we've seen. And you can look at that top chart at the on the right, just to kind of see the difference between certain styles and certain capitalizations. We know that large cap growth is really trading above its 2-year average, and it could be different than some of their value counterparts. So something that we're looking at going forward. Here is just, it shows the proportion of stocks from each sector with that greater than 100% price return. We can see that tech, healthcare, and consumer discretionary has had the highest number of stocks with the greater than 100% price return. So the sectors with the highest number of stocks with less than negative 25% returns include financials, REITs, and energy. So I've kind of broken that out at this bottom chart. We see that infotech, healthcare, consumer discretionary does have the best year-over-year price return, but their P to E's are still trading above their 2-year averages. But again, they do have the best forward 12 months earnings growth estimate compared to financials and energy below with the lowest growth estimates going forward. So I just want to talk about some of the portfolio impacts and some of the things that we see because of all of this information. Consumer discretionary being underweight here has caused a negative allocation effect for us. And we believe that discretionary spending may increase as dining and entertainment begin to ease restrictions, and we may see a boost with holiday sales there. So it's something that we want to potentially increase our weighting there. Consumer staples, we will remain overweight. We're not going underweight. This is just trimming the sector because we've heavily weighted the sector because of the trades this summer. Our selection here in Procter & Gamble has performed relatively well, just rebalancing there just a little bit. Financials, we understand the headwinds that the industry faces. Interest rates will remain low. We know that this compresses lending margins and that defaults could increase, even if, if the slowing of the recovery slows down employment gains, if layoffs continue or increase, if stimulus isn't passed. There's a lot of things to kind of think about here. But we do see low valuations. We do know that if a recovery does take foothold, that some of these larger banks and companies could benefit from this. And they have the fundamentals, I believe, to back up some of their valuations. With industrials, we just want to have that exposure to some of the cyber defense companies. We'll have a stock update that kind of talks about what we may be thinking about here. With technology, we are underweight. We do want to increase our weighting here to be overweight. We like tech companies because of their long-term trends that have been pushed forward by the virus. Again, 5G, the Internet of Things, remote working. We realize that these valuations are stretched, but we think that these companies have really long-term growth that we like. So those are some of the companies that we're looking for there. Finally, just touching on utilities. Again, Essential Utilities, which is formerly Aqua America, they are water utility, have performed poorly for us this past couple of quarters. And so we favor Nextera, who is our other utility holding. They focus really on renewable energy and production storage, and that's what we're favoring there. So I just want to give a brief update on where we are with our ESG ranking system. So back during the summer, we had a special meeting of an ISM and talked about how COVID-19 changed things and how we look at companies and research. And ESG investing has gained major popularity over the past few months and increased focus on inequality, climate change, responsible company management, all these things. And so we wanted to create a system that we could use to incorporate as a part of a holistic process in our reports. But what we saw is there's several problems with static measures. Static measures fail to recognize potential improvement with companies moving forward. If things are poor now, but there's really a lot of improvement on the horizon, those metrics may not recognize that. And the metrics could reward excess spending that doesn't really create value for the company. So if they're spending a lot of money on a certain thing that a metric likes, that scores well, but it doesn't create value, that skews the data there that we're looking at. So what we want to do, I think, is to really focus on, combining that with some qualitative measures. And it just changes the idea of a formal ranking system for us. So the idea may be that we set a threshold based off of quantitative metrics, maybe monitor those over time and use it as a screening system. So if the metrics begin to improve, we can take a look at those companies and then combine that with sort of our qualitative measures and questions that we want to ask. So have they been a part of any controversies, or have they had issues with management in the past couple of years? Do we see improvements on the horizon? What is management thinking there? And so just wanted to give you that update to show where we're moving. We are sticking with this, but the idea has changed. We do think this will be better going forward and incorporating that into reports. but I'll open that up to questions now, if anybody has anything.
Hey, Jacob, I know you guys are still working on this, but talk to me a little bit about how, let's say, for example, you have a really good performer that has been in the fund for a while, but then you run your ESG screen and it scores quite poorly. What's the policy going to be?
Right. I think we still need to figure that out, right? But it's not a single variable kind of thing. We want to incorporate it with the valuation, with the company description, with all the company financials. So it will be a holistic process. And some of the things, you know, that we're looking at, especially, is that companies improving or, you know, may not be socially responsible companies that make improvement are really good performers for us. So I think in the event that we hold a company already, we want to focus on improvement. And if they're not making improvement with ESG scores, then maybe we take a look at that. But again, focus on the improvement, maybe not the current score.
Yeah, there's been, you know, Ray, I'll chime in here. There's been a lot of discussion here. So one of the things they've considered is a base score that they would like every company to be at. And then above that, they go to more qualitative data to decide if they want to invest in companies that are improving in social responsibility or and ride that wave of and maybe they get more popular as they get more socially responsible, or go to the best performing companies in terms of social responsibility. And I think that they're having some natural great discussions, but also running into some of the issues we've talked about on some of the committees we've been on before, which is each company, each metric, it's very hard to dial in exactly what they're doing or how they're measuring, because there's some differences there. And so I think they're trying to not marry themselves to a specific score, because that could hamper the discussion. They'd much rather have a list of questions that they want the analyst to answer in terms of social responsibility, and then use that discussion to drive their decisions.
Okay, that's interesting. Yeah, I would also suggest maybe looking at it from a portfolio basis too. So, you know, you can include, say, a company whose ESG metrics are lower, but by virtue of other reasons you want to include it, but that the overall ESG score at the portfolio level is above a certain benchmark, right? So that would, if you do it that way, it would force you to, if you're willing to include a certain company just because you like the business fundamentals so much, and maybe they score low now and you see ESG improvement in the future, that would also force the team to find a company as an offset that has a higher ESG score. And that's typically what you see from the managers who specialize in ESG funds.
Kind of like buying carbon credits, if you.
A little bit, yeah. I mean, it's the way it works now, but that would be something that I would suggest you look at, is maybe at the portfolio level.
Sure, yeah.
This is Reese. I was actually reading some of the chat, and I saw Jay Dale's comments specifically on financials, and I noticed when you were talking about financials and bringing it back to equal weight, that you were talking a lot about the risks associated with poor credit quality. He highlighted that as well. Is there an opportunity potential if there is, you know, inflation and we start seeing interest rates and spreads start to widen? And have you thought about maybe quantifying, you know, what the downside and the upside risk is and measuring that, so you can determine if you want it to be more allocated to a specific sector that, as Jay also mentions, has been hit really, really hard, to see maybe if there's an opportunity to get into that sector. I mean, I think there's going to be a very different, you know, energy's been hit really hard. You've talked about that's probably more of a permanent thing. Do you see that different in financials?
Yeah, I think that's where we need more research. I think that's where we definitely need to pass that off to the analysts to find the individual winners. And then as an officer team, just finding those industries there. Again, we've not really, we have trades on the horizon for some of these other kind of trends and themes that we talked about with the portfolio. The financials thing is just something in the beginning discussion. So I'm not sure when those trades come. So I'm not saying this will happen before the next ISM, but it is something that we're talking about and maybe looking at an entry point there going forward. But it just to kind of introduce the idea that those are what we're thinking about there.
Anybody got any other big theme questions? Because Liam will be the last officer that'll go here in a second, and then they'll probably get more specific. So if you've got some big theme questions that you want to throw out right now, by all means, ask away. I do think that they, Reese and Jay have made a big point that, and Ray's mentioned this too. You got to make sure you have an agreement on whether or not you think inflation is going to happen, and right. And I think getting that right could be a really big decision, especially in some areas like the financial sector. And then when you say picking individuals, I assume what you're meaning there is that some like financial institutions would benefit from a low interest rate environment and others would not.
Yeah, correct. Yeah.
Okay.
I have one more big question, like big picture question. This may be addressed on the next one, but I'm just curious. How did you have 13% overperformance in underweight in technology? Like, what led to that? Because that technology obviously is the best performing sector, and to be underweight that sector but still outperform the benchmark so measurably. Can you give me some sense as to where that came from?
Yeah, sure. So I don't want to steal Liam's thunder. He will go over sort of our allocation and selection effect, but we have historically been really, really good at selecting our stocks, and he'll show that in just a minute. And so we've done really well with selection there. And again, I think that the allocation has been distorted over the past couple of months, especially as technology has grown, but I'll let Liam kind of cover that a little bit.
Great, thank you.
Yeah, that's a great segue for, thank you, Reese. That's a wonderful segue for Liam. So if Liam doesn't answer that well enough, Reese, bring that question right back up. Take it away, Liam.
Awesome. My name is Liam Christensen. I'm the Vice President of Risk Management. Today I want to go over with y'all a little bit about our beta and trainer ratio, and then I want to get into our allocations and talk about the narrative that Jacob and Melissa have been pushing as far as what we want to be overweighting and underweighting in and rebalancing. So on this slide right here, in the last ISMs, we've mentioned wanting to improve our trainer ratio, and through careful selection this summer, we've been able to do just that. We're seeing more returns per unit of risk with the improved trainer and a beta closer to the S&P. We are following along well with our plans to mitigate risk while seeing solid returns even through these pandemic times.
Hey, Liam, I'm just going to stop you right there. I just want to let everybody know this is a typo. This was supposed to say 12.
It didn't save when it went to, because the file was so big when we were emailing it back and forth. I guess this one wouldn't update because there was an error when I went to pull up this presentation.
Yeah, so that should be a 1, not a 2. And then that's I saw them practicing last night and everything. So this should say 12 and this is 9 and 3. Combining all the files, I think hitting save every time, they didn't always work perfectly. But anyway, just let everybody know that trainer is 0.12. Keep going.
Awesome. And then on to the next one, please. Next slide, please. Thank you. So there's a few things I want to highlight in here. Within consumer discretionary, we have great returns and we're continuing to outperform our benchmark substantially. And I believe this has been due to the careful selection of the last team and also the diligence of Melissa and Jacob over the summer. They worked tirelessly over the summer, especially with this sector, to try to get to where we want to be. So this furthers our point that we want to become overweight and discretionary moving forward. And then within industrials, we are still doing well, but we're performing much better in this sector than previously this year, which is why I feel that I wanted to highlight it. Earlier this year, we were performing at negative 6.9% on our returns. And as you can see, it's a dramatic difference as of right now. And then coming back to information technology, this continues to be our strongest performer in the fund despite being underweight compared to the S&P. And we still continue to outperform the benchmark, and as we move forward, we want to be overweight in this sector. I believe this is just because we've picked stocks so well, and moving forward, we would just like to allocate those funds a little bit better within IT. And then lastly on this slide, I wanted to talk a little bit about utilities. I want to point out our allocation and selection effect. As Melissa and Jacob have previously mentioned, we feel we are overweight in this sector, and moving forward, we would like to be slightly underweight. We feel we can pick some better companies of this sector as well as allocate some funds, but altogether, we just want to be underweight. So to conclude, we're going to push for heavier weightings in consumer discretionary and IT while trying to mitigate our risk and understand how COVID will continue to impact this market. And I think these presentations coming up are going to further prove these plans that we have. So I'm now open up to any questions.
So I think the Reese's question, I know that the fund owns Amazon and has owned it for a period of time. And then you also own Netflix, I believe, right?
I believe it was Amazon, Apple, PayPal, and Netflix might be up there as well.
Right, but specifically in the consumer discretionary sector.
Oh, okay.
Because the Apple would be in IT.
Yeah, discretionary is mainly Lowe's and Amazon.
Yeah, Lowe's and
Okay,
Amazon.
so it's Lowe's and Amazon were your contributors to the alpha. There is a policy limit, is there not, Hunter, on how big a position can become?
They can, but they've actually not gotten as high, and to the point that we did have to trim Amazon at one point, but that was also because we bought more of Amazon right at the bottom in March, and then of course it skyrocketed. So
okay, perfect. So so then I think Netflix actually might be, I don't know, they created that new sector, the communication services, so I'm not sure where they are, but I think Netflix is in there. And then IT would be Apple, and then what else is in there?
So for IT, I know that we have Apple, Microsoft, Splunk, and PayPal, who have been our real outperformers there.
Okay, gotcha. All right.
And then Reese, to your point, I think the students have done a very good job choosing the stocks. They have not weighted those as well as they could have to really capture some of that allocation effect. See, almost all of it was captured through selection, and I don't know what just happened to but if you look, they're going to talk about healthcare a lot in the next ISM, and they do need help there. So they do have a couple areas where they could get a little bit better with selection, but for the most part, they did pick the big winners, and I think that I think they picked them for the right reasons. I don't think they got lucky. I think that they were about those throughout the whole trend. So I give them a lot of credit there. But if they're going to do better in the strategic fund, like Melissa said, they really need to get this allocation figured out and hopefully do better there, because they could benefit from that same information in some of their sector ETF moves that they would make in the strategic fund as well. All right, any other questions? All right, we'll move on to the analyst then.
Alrighty, wonderful. Well, good morning, everybody. Melissa, if you can actually jump to the next slide. Awesome. Who doesn't like to look at a good fighter jet? So, well, good morning, ladies and gentlemen. Welcome to the Smile Fund's first ever, I think it's our first ever virtual ISM. My name is Drew Reynolds, and I'm a student and industrials analyst here at UTC. And today we're going to be talking about Kratos. So Kratos provides basically mission critical solutions to the United States, the government in particular, allies, lots of customers abroad, and then some commercial customers as well. So just to give everybody just an idea, you know, of where we're going to go with these types of presentations. So I like to do a brief company overview, dig into a few of the key financial statistics, move our way through evaluation, go through some of the risks, and then hopefully we'll round out in about 10 minutes or so. So without further ado, let's get started. So we are saying this is absolutely a strong buy. So buy it while you can, all right? we're saying that Kratos is showing to positively increase just 0.1% shy of 23%. Next slide, please. All right, so just to give you a quick overview, so Kratos is headquartered in San Diego, California. They were incorporated December 19th of 1994 and really do everything you can imagine at 30,000 feet above our atmosphere. So target drone systems, which are designed to replicate state-of-the-art fighter aircraft, ballistic missiles, just about really any other threat you could imagine. So they also just recently got into the space and satellite communications world, cybersecurity warfare, microwave electronics, missile defense, hypersonic systems. So again, the primary end customers being United States government agencies and allies and the Department of Defense, some intelligence agencies. They actually split their entire reporting segments into two. So the first one being KGS, Kratos Government Solutions, the second one being Unmanned Systems. You'll hear in conference calls refer to that as us, to put it simply. So next slide, please. So just to give everybody sort of a normalized idea of the price performance since the beginning of the year, Kratos is outperforming the S&P and outperforming aerospace overall. So definitely some positive vibes, as we like to say, coming from Kratos, especially right now. I will make a quick note. Yesterday, they actually reached, about 1 o'clock yesterday, they reached a 52-week high of $22.11. That's the highest close since July 31st, 2019. Next slide, please. So diving more into the financial backbone of the company, we're able to see that although fiscal year 17 and 18 were tough on Kratos, they're finally starting to and projected to make some serious revenue growth here in the near future. So fortunately for us, Kratos has a lot of recurring revenue that come in the form of 1, 2, 3, sometimes even 5, 7, or 10-year contracts with often guaranteed payouts each year, so long as they are able to meet certain metrics. So we will actually go to the next slide. Moving forward through the financials, we thought that it was important to note that as of June 28th of this year, cash and cash equivalents were around $397.2 million. That's up from $172 million, 12/31 of last year. Long-term debt to equity has really tanked since Q4 of 2019, essentially telling us that the company is duly able to meet their obligations. So I'll also take just a quick minute here to note that their current ratio is 4.38, which is higher than the previous quarter's current ratio of 2.83 and the highest in the past 8 quarters. So again, some really positive things coming from that.
Sorry, may I interrupt? Where did the cash come from?
Yes, sir. A lot of it was a increase in volume and shares.
Sorry?
Increase in volume.
Increase in volume of what?
They issued more shares.
Okay, so they did a share issuance, but did they issue those shares to pay off the debt?
To my knowledge, they issued the shares to pay off only a portion of the debt, and then they issued more shares just to try to get an edge up on the game. They had a lot of issues paying for the upfront cost of some of the raw materials that were needed for some of their jet technology. So they actually make a note of that quite a few times.
Okay, all right. So they somewhat recapitalized. Okay, I follow now. All right, thanks.
Yes, sir. All right, so what are you trying to get at, Drew? You've been talking for like 5 minutes. What's the punchline, right? So Kratos stands to benefit strongly from rapid growth in, and if I can, for the first moment, Kratos is a consistent and really an almost secular grower with a very dominant position in a niche aerospace market. So there are not very many people creating jet drones that can fly at Mach 3 next to an F-18. So combining the first two momentarily, just to kind of give you an idea behind the push for some of the 5G satellites that Kratos is involved in. So Amazon and Amazon Web Services are planning to launch around 3,200 satellites within the next 14 months. OneWeb set to launch 650, Telesat with 292, and 108 combined between T-Mobile, Verizon, and the FCC overall. Fortunately for us, SpaceX rounds out the top of the 9th inning with 4,425 planned launches within the next 14 months. So what does that have to do with Kratos? Well, about 75% of the on-the-ground technology and the login screens for all of that, all those components on the satellites will either have a Kratos logo on the side or a Kratos logo on your login screen. So really some great things coming there. If I can touch on the final 2 bullet points. So the fiscal year 2021 defense budget reflects a 28% increase in space and satellite services alone. And luckily for us, Kratos is the primary unmanned aerial target drone provider to the Air Force, the Navy, the Army, and of course those intelligence agencies that we were touching on earlier. So looking towards a military refresh as a whole, the military is placing Kratos and Dynetics, Northrop Grumman, Raytheon sort of at the forefront of what are called the Valkyrie, Skyborg, and Golden Horde programs for the Air Force and the Navy. Those are not more themes to Ocean's 11 movies. Those are actually jet drones that will replace FA-18s in the Navy, F-22s and F-35s in the Air Force, and essentially create an advanced battle management system where fighter pilots will actually start commanding fleets of hundreds of drones from 3,000 miles away on an aircraft carrier. Next slide, please. Alrighty, so diving into sort of the meat of the company and sort of what it's all about, we see this through some of the comparable metrics of the things that probably stick out to us the most: year-over-year revenue growth, earnings per share, 1-year growth, and a 300-point PE. We have reason to believe that comes from an acquisition, a $35 million cash buyout of a company that happened earlier this year. And so usually their PE hovers around anywhere from 36 up to 54. And so we will forward on to the next slide after this.
Wait, can we stop for a second?
Yes, sir.
Okay, so did they buy a company? I don't quite understand your comment. They bought a company using cash.
Yes, sir.
And from that acquisition, their PE exploded 10 times. So how badly was this company burning money?
Evidently pretty bad. It was ASC Signal Company. They bought it. The company that they bought it from was called CPI, Commercial Power and Industries. They basically do everything satellite related. So from what I can gather, everything that the company was doing, they were sort of driving themselves basically into the wall and funding a whole bunch of upfront costs and just throwing billions of dollars at some of these geosynchronous satellites.
Hey, Drew, is the PE ratio because of the company they acquired, or is it because their earnings were temporarily extremely low from buying that company? What was their PE the years before?
Sure. The PE the year before was actually 56, 2019, and 2018, 64.
Okay. Well, I mean, Hunter, my point is that it sounds like they did a dilutive acquisition.
Okay.
And highly dilutive acquisition. So then they recapitalized the cash that they used by issuing shares because their PE is elevated. Tell me something, Drew. How do you react to an ROE that's in single digits? I mean, when you evaluated this company and you look at this profile for a market cap of less than $2.5 billion. So I mean, talk to me a little bit about why and how you think this is a worthy candidate for the portfolio. I'm kind of picking at you a little bit here just because I understand your enthusiasm, but I would like to better understand how you can justify the valuation for this thing.
Sure. I think it's tough. I think it's really tough, because all their competitors are really outdoing them on the return for equity. I think that what I had to balance was the fact of the market that they were in and the things that they were doing. And so there really are not a whole lot of great competitors to sort of put them against. They're kind of the leadership at Kratos isn't worried about anybody on their doorstep. They're not really concerned about some of their strategic partners. They're just sort of doing them. And so I really looked at, the ROE and I was like, okay, well, single digits, I haven't exactly really seen this a whole lot before, but let's see what happens with this cash flow.
Drew, I'm a little concerned about the customer mix. I mean, is the U.S. government their primary customer?
They represent about 3/4 of their primary customers, yes.
And they lock in some long-term contracts here, or how does this work? Because if you're that sensitive to one customer, what if the U.S. government decides they're going to diversify their sources?
Sure, that's a great point. That's something that they're concerned about with administration changes sort of coming through the Pentagon and obviously November. I think they actually do a great job at sort of trying to diversify their satellite and satellite services. So they actually just announced yesterday that they're going to start offering advisory services to a lot of other government agencies as well, to try to get involved more with the Department of Defense, sort of from a really a zoomed out level. So I think, I think it's important, and they understand that they're going to have to balance the fact that some of their strategic partners may land a contract over them, and there's not going to be much that they're going to be able to do about it. So yeah, that's.
Yeah. I'm afraid I still don't understand the 305 PE on this company,
Right.
And the 10 times explosion on it. I'm struggling with that.
Sure. All right. We will continue then. All right. Moving into some of the assumptions that were made here, sort of in the DCF and why. So here we were able to derive a weighted average cost of capital of about 8%. Gave us a base price of $24.47. Again, that's nearly a 23% increase from the current stock price. So next slide, please. So talking about some of those assumptions that were made that we just briefly touched on a second ago. So beginning with the downside, as Dr. Lobo was saying, we had to come to the pretty strict belief that they have a positive relationship with the government, but what happens if they don't? So if they don't, they're obviously really going to be hurting pretty badly, and they're obviously not going to grow as much as they could be. So those apprehensions, or maybe some apprehensive attitudes towards the Air Force, the Navy, or maybe even some of their satellite contracts, caused us to really discount the current base model by nearly 1% overall as far as a terminal growth rate. So that's reflected here. Hopefully what happens is they have great lobbyists at the Pentagon and in the Congress, and we're able to see the upside case. So swinging from left to right, moving towards the upside case, there are obviously a lot of things that Kratos does that really made it difficult for us to really analyze. So a lot of things are still classified, or a lot of people are still under a non-disclosure agreement and not able to talk about a lot of the cool things that the military is doing. So we really had to make some assumptions about what sort of contracts were maybe about to come down the line for them within the next year. So that sort of amounted to around 40 million in government solutions contracts, around 30 million in unmanned systems, and then we saw about 100 million increase in wireless contracts that could be gained or awarded hopefully within the next year. And that upside reflected about a 0.5% increase in the base case, and really expanded on a possible bullish run for the company sort of overall. But again, ultimately, if things take a downturn, they're going to take a downturn pretty quickly. So next slide, please. All right, so speaking of some of the downstream effects, obviously let's briefly touch on some of the risks rounding out this fiscal year and definitely into next year. So Kratos has primarily had contracts and test flights get delayed. That's been really their most serious thing. They've also had some pretty serious supply side shortages due to COVID-19. Kratos, Raytheon, Boeing have really all experienced the same supply side shortages, getting steel from the same suppliers, getting services from the same suppliers, a lot of their parts and components, and even down to some of those raw materials. So thankfully, Kratos has began, buying some of that inventory back, and they actually had a head start on it, nudging into February and March of some of those already difficult products to buy. So moving into our absolute favorite thing to talk about is the presidential election. So if we remember December of last year, if we take a step back for a moment, we remember that there was a $1.4 trillion spending bill that we had to avoid a government shutdown, of which about $738 billion was for defense alone. And further decomposition revealed that about another $40 million established a new Space Force, and another $146 million for a new broad laundry list of military hardware. Kratos is included in that. So the fiscal year 2021 budget is composed of really a two-piece warfighting and overseas contingency budget of $671 billion. So Trump's three budgets alone drove defense spending up by $100 billion compared to Obama. And really with the Democratic ticket side, we really had to come to the idea that Biden really hasn't made a whole lot of comments about defense spending. And so the thing that we have to our advantage is that defense spending overall really does not change that much between offices. It's really not as cyclical as most people think. Of course, the Bush and the Trump, Bush Jr. and the Trump administrations being the obvious outliers within that statement. So finally are the presence of substitutes. And just to put it briefly, a lot of times Kratos has to bid and apply for or be selected for some of those really large contracts that may come across their desks, sort of as myself and Dr. Lobo were talking about earlier. But the goal for Kratos is obviously to be a model for defense affordability. And sometimes their strategic partners do land contracts over the M's, and that's something that we need to keep in mind. And I believe, next slide, please. I believe that pretty well rounds us out. That current price is as of this weekend, not getting any sleep doing this. So.
All right, we got any questions? All right, I think we had some good questions as we went through. Thank you, Drew, very much. Joel, you're up next.
Hello, everyone. My name is Joel Overton. I'm the Chief Analyst of the Health and Wealth team. Next slide, please. Today, I'm going to be talking to you about Hannon Armstrong Sustainable Infrastructure, and I'm going to be recommending this company as a sell. Next, please. Hannon Armstrong is a company that is set up as a REIT to maintain certain tax incentives rather. But what they do is function as an ESG investment bank. They make investments in various climate change technology solutions and are proud to be dedicated to making only investments and in lessening climate change, especially carbon reduction. Next, they focus in three principal areas: grid connected, behind the meter, and sustainable infrastructure. Next, please. Sustainable infrastructure is their smallest market segment at only 1%. Grid connected projects are their second largest at 37%, with their behind the meter investments accounting for 62% of their holdings. They generate revenues primarily from interest payments. 54% of all revenues are from these. Rental income and gains from the sales of receivables and investments account for 35% of their revenue, with fees being the last 11%. Moving on. Functioning as an investment bank, they maintain a low portfolio risk with many small investments. They want to only invest in efficient technologies because they think that more efficient technologies are going to yield higher returns. They only want to invest in, what the scientific community has already agreed upon, and in particular, they focus in on investments concerning carbon emission reduction. Moving on. Their behind-the-meter operations are building or facility-specific investments that reduce energy usage or cost, from solar energy generation and electricity storage, all the way to energy-efficient improvements like HVAC, lighting, and roofs. Their grid-connected holdings are where they maintain their status as a REIT. They make investments into solar and wind energy projects and lease the land to energy companies like PG&E. Their sustainable infrastructure receives the smallest portion of their investments. They do smaller projects here with cities and smaller utility companies for things like energy distribution system upgrades and stormwater remediation to prevent pollution to water going into lakes and streams. On all of their investments, they use their proprietary scoring tool they call Carbon Count to measure how each dollar invested will reduce CO2 and CO2 equivalents. They keep a yearly measure of how much their carbon dioxide and water, how much they save year over year. Moving on. It's not really an unpopular idea. Wind and solar account for the majority of all renewable energy investment. And in the next slide, we'll see how wind energy production is increasing. In the next slide. And in the next slide, we will see the same trend going for solar energy. On the next slide, we can see how they even capitalize on obvious signs that we are facing times of lessening precipitation and increased drought. The map at the bottom shows the standard precipitation index from now to 30 years later on the left, and on the right is the drought severity index over the same period. They have a management team that can be considered experienced, with an average length of time with the company at over 5 years, but much of their team has many more years of experience in investment banking. With measuring this company against other comparables, I really wanted to look at how much they were leveraged, and they aren't the highest in terms of leverage. They do have the highest profit margin, but their asset turnover ratio is the lowest in their comp group.
Hey, Joel, so on that previous slide, OPM is what, operating margins?
Yes,
Okay,
operating profit margins.
thank you. And what are you using there? What's your numerator?
I just pulled the data, honestly.
Okay. I mean, I noticed, I don't know, I'm not familiar with Armada Hoffler. I guess that they're a REIT.
So the top two.
Normally, I'm sorry, but yeah, normally you use a metric that's unique to the REIT sector, which is called funds from operations.
Right.
So
actually.
Sorry, is that what we're looking at, I guess, is my point?
So yeah, this is from their operations profit margin. And I use different instead of, because I did do, you'll see here in a couple slides where I did a DCF and I used a metric similar to the adjusted funds from operation on that. And that's where I dig in more on their operating, or their funds from operations. So what I wanted to do to find a price target was use a discounted DDM model and a DCF. You can see how the WACC is calculated here, and with our dividend discount model, it gave an intrinsic value of 32.32. I did have to account for share dilution with the number of shares on this, because every year they issue out more stock to fund their business. DCF, I had to do the same thing with share to account for share dilution, and I used I started with the growth rate and applied it to their core income. The core income adjusts for capital expenditures and other adjustments. It's similar to the adjusted funds from operations, which is a better measure of earnings potential than free cash flow. And using this method, I came up with an intrinsic value of 38.50. I wanted to blend these together at 50-50 weight to get a blended target of 35.41, which is a 13.2% decrease. Risk with this company is they have to maintain their REIT status to maintain tax incentives, as well as issuing more stock to fund their operations. Another risk is that there are cheaper alternatives to green energy. Oil right now is super low, and if these fossil fuel options remain cheap, then I foresee slower growth in the renewable sector. Their assets are illiquid. These are long-term projects that they depend on these cash flows, and they depend on these cash flows to satisfy their debt obligations, and they have low asset turnover. So we have the pros is that they have decent growth. They're not highly leveraged. They have an experienced management team. They have good revenue growth, but it's just it's overbought right now. They're having to depend on these long-term future cash flows, and their current market price doesn't reflect their actual value.
Joel, I thought that was a good presentation. Tell me something. You brought it up a couple times. Is there some reason to be concerned that they would lose their REIT status?
So not a specific reason, other than they're always buying and selling different holdings, and they may have to liquidate certain assets in order to maintain that status.
Well, I think maybe offline, maybe we can follow up with each other, because I'm not sure I follow all of what you just said, because that's generally not how the REIT structure works. But anyway, we can talk about that offline. The other thing I would suggest is, typically when you're looking at REITs, which are income vehicles, one of the ways these trade are by dividend yield. So, be cognizant of the fact that, Treasury yields are below 1 out through I don't know how many years. And this thing does have a dividend yield close to 3.5%, which I think if you go back to your comparison with the data center REITs, Digital Realty, and Equinix, I don't think their dividend yields are as high. In fact, I can check right now, but I think that their dividend yields are substantially lower than Hannon Armstrong. I think it's an interesting idea, actually, and so maybe offline we can take a look at some things if you want to follow up with me.
Okay.
Yeah, I know that when he first started doing this, that he had him as a buy, and then as he learned more and more about the valuation process, that value started to come down, and I was really impressed with how many times he cycled back through the valuation process. It seemed like each time he got more and more bearish. But how'd you pick your peer group? I know that some of these are not that comparable. And then the other thing I would ask, Joel, is did you consider using price to funds from operations as also a column in your relative valuation?
So in choosing the comparables, it was difficult finding the information that I wanted. I ended up using the Digital Realty Trust and Armada Hoffler, because they are real estate investment trusts, and where Equinix and First Solar are more solar energy generating companies. It's hard to find a good comparable group for Hannon Armstrong, because like you mentioned, Mr. Ryan, that they don't function as a normal REIT. They do function primarily as an investment bank. They just keep their REIT status for tax benefits. And I did consider using the ratio you mentioned, the price to funds from operations. I just honestly, I was running out of time, and I wanted to show the DuPont analysis.
Yes, I think from now on, we should make it a policy just to at least begin with a slide of DuPont, and then we may take it out if it doesn't show anything. But I would have liked to have seen a DuPont, Drew, on yours. I think it could have helped show what was going on there with the ROE. Other than that, and you may have taken it off because it didn't show anything, but I do think that it was smart for you to put the DuPont in here. Or do we have any more questions? I think it's a fascinating idea of socially responsible REIT. I think it hits on a lot of the students' themes that they're interested in. But REITs can be somewhat complicated, and they are still willing to learn. We've had some folks message me privately that they would be interested in holding a boot camp about REITs with the students. I think that's a great idea. So, it's a really interesting concept. Thank you, Joel, for going over it for us.
Hunter, I'll be glad to help if you get that set up. My question, for the CFA challenge, have they picked a company yet?
They told me they were going to have it picked last week, and since I'm the one that's bugging them, I've already sent them 2 or 3 emails. I was hoping that they would just tell me, and I wouldn't have to be the one to bug them again. But if they don't let me know by tomorrow, I'm going to bug them one more time, because they told me they would know by Thursday of last week. I suspect they're just doing some I guess some finalizations and making sure that company's really on board.
Because I think there are members of that team that I helped with when we had to do Ryman, which was a REIT. And
yeah,
so we could start with that report.
You're talking about Yelena's team?
Yeah. Shane, weren't you on that team? I thought Shane was on that team.
No, I had dealt.
Yeah, Michael Swanson just said, yeah. So we've got some experience looking at REITs with people on this call. Yeah.
All right. Well, good. We'll take a look. I do like this, and I also think real estate is going to be a very interesting market for the next year or so, especially if there is a significant change in the values in urban real estate and in brick and mortar commercial real estate. So I think it's great, Joel. I really do, and hopefully we can redo this. We'll get it on the approved list, or maybe get another REIT that you like on the approved list in this space. That because that would certainly be something we'd be interested in.
Excellent.
All right. Last, we have a tech update, which I think you all like because, of course, tech has been a really big mover in the markets. So with that being said, Stephen, let us know what's going on in IT.
Thanks, Dr. H. How's it going, everyone? My name is Stephen Gordon. I'm a junior analyst in information technology. Let's get started. So here's our current holdings. As you can see, our two highest weighted holdings, Microsoft and PayPal, both performed very well. Tech actually as a whole did very well, with the exception of the Intel, who's lost Apple as a vendor and has had a chipset of theirs delayed. Moving on to the next slide. Here's our earnings report. So earlier this summer, Microsoft announced it'd be killing off Internet Explorer, who will no longer receive support after August 2021. This could save them up to $100 million a year. And considering its user base has been declining over the past few years, this is a smart move. Some of you may have heard that ByteDance will have to sell its social media platform TikTok to either Microsoft or Oracle. Right now, it's unclear if either of these deals will go down, but currently the rumors are that Oracle has a better chance of acquiring the company than Microsoft does. Go ahead and go to the next slide. So Intel is no longer Apple's CPU provider. Instead, Apple has started to produce its own silicon. This could reduce production costs by a significant margin. Intel's i3 processor is rumored to cost somewhere between $200 to $300, and that an Apple-produced ARM-based CPU could cost less than $100. Moving on to NVIDIA. NVIDIA is set to release an incredibly competitive graphics card, both in performance and in price. Most heavy PC users stay with their graphics card for years, but one as affordable as this and that outperforms most cards, both by competitors and by NVIDIA, will certainly attract more buyers. NVIDIA is also trying to acquire ARM, a chip-making company that produces chips for Apple, Samsung, Huawei, Qualcomm, and NVIDIA themselves. This deal is likely to receive opposition from both the UK government and NVIDIA's rivals, who purchase chip designs from ARM. But if this buy does go through, we can expect to see a downtrend in pricing for NVIDIA's cards and a continual uptick in performance. Moving on to the climate for the tech sector. In March, you can see a downtrend for this sector in the S&P 500, with the latter outperforming IT. It seems that both returns have bounced back to normal, or bounced back and returned to normal. The reason this happened is because more people are working from home, more people are investing into cybersecurity, and people are making online purchases more now than ever. Moving on to the trends in tech. So the first trend you see here is workplace flexibility. In this time of quarantining and social distancing, many companies have allowed or had their employees work from home. Salesforce has reported an increase in productivity after having employees work from their homes. And also Google and Facebook have told employees that they are permitted to work from home until next year. This seems that it will be a permanent option for employees moving forward. The next trend I've got here is 5G. While 5G might not be a traditional trend, in some way or another, most companies in the tech sector will be required to deal with 5G in some way, especially phone companies. Google, Samsung, Apple, and a myriad of other phone companies have been forced to implement 5G chips into their phones. We can expect to see Apple unveil their first ever 5G iPhone next month. This being said, chip suppliers like Qualcomm have already adapted to this. And as 5G infrastructure grows, we can see the demand for 5G too, as well as it becomes more affordable. This is why I'm recommending Qualcomm as a buy, as they've monopolized the market for making 5G chips. They're basically their only competitor is Exynos. While both companies provide these chips to Samsung, Exynos is only supplied in Europe, where 5G is not growing nearly as rapidly as it is here in the US. The next trend I've got here is cybersecurity. As more and more companies are becoming cloud-based, security is becoming more and more important. CEO of Microsoft, Satya Nadella, admitted to investing over $1 billion a year in cybersecurity and will continue to do so for the foreseeable future. By 2022, the global security market is predicted to be worth over $170 billion, whereas in 2004 it was only worth $3.5 billion. This makes a lot of sense because the more these companies progress and the more technology progress, the more of the consumer's information they will hold and the demand for privacy will continue to grow. My last trend here is self-sustainability. As you've seen earlier, both NVIDIA and Apple are making moves regarding self-sustainability, with Apple moving to produce their own CPUs for their computers and NVIDIA buying their chip vendor ARM. While this might not be something we see with every company within their markets, I believe that we will see the sector's leaders make similar moves comparable to NVIDIA and Apple. So moving on to NVIDIA specifically. So the reason why I'm recommending NVIDIA for a buy so hard is the graphics card that you can see here up at the top. You'll click that animation. Thank you. Its performance to price ratios is incredibly high, comparable to last year's flagship model. You'll click that animation again, Melissa. You can see diminishing returns in performance as the price increases with this card. So with this new card, the 3080 at the top, you see the new price, new performance, and you can see that they made a huge leap where value is concerned. So what about their competition? Go ahead and go to the next slide. So their biggest competitor is AMD, which has a similar card called Radeon. That's their lineup for it. So they're also releasing a new card in late October, a few days after NVIDIA is releasing this card. It is expected to be slightly cheaper than NVIDIA's card, as AMD has slightly undercut NVIDIA historically. But with no access to NVIDIA's superior software, which is DLSS, Radeon will not, let's see. The 3080 and 3070 cards will have a much better value, and it's clear to consumers that this is true. Are there any questions?
All right, so it looks like you want to hold what we've got and basically add these two, and this is the way we're going to increase the weight in this sector, Melissa? Maybe?
Yeah, we've definitely talked about his ideas, and we're going to implement some of them.
Okay, sounds good. Anybody got any questions? Yeah.
Yeah, Hunter, I pulled up the portfolio, and so as of last night, Amazon's at a 6% weight. Next is, I think, Microsoft at 5.7 and PayPal at 5.1. So remind me, what's the policy limit that triggers?
Okay. Yeah, so they can't buy any more after 5%, but it can run up to 10% before they have to sell.
Okay, so there's some room left on these names, right?
Correct.
So that said, you guys did a great job back in March buying some more Amazon and whatever. I like the idea of spreading this out, spreading out the number of names. I guess my question is to this group. Everything I've heard on this call, I think presupposes a continuation of. And I might be selling y'all short, so I don't mean to do that. What I'm trying to put into maybe a little bit of perspective is, to the extent that COVID represents an acceleration of trends that are somewhat in place, that were already in place, and we've seen a pickup in some of this work from home and so forth. If we get, and I'm saying that's a big if, I'm not trying to be predictive here, but if we get positive news on the vaccine front, if the timeline that they've laid out bears fruit and we see economies reopen again, there's a lot of discussion that some of the value sectors that have lagged will close the performance gap to the group that you are contemplating adding more money to, right? So playing devil's advocate a little bit, given how much of alpha you have year to date, you know, throw on the table that maybe the team should consider protecting that alpha a little bit and rotating into some areas that haven't kept up that would be bigger beneficiaries if we get a faster return to normalcy. I throw that out there just, you know, for discussion purposes.
Yeah, that's definitely something we've been thinking about. I know the officers ourselves have been talking about possibly trimming our top holdings a percent or two and reallocating that money to somewhere that maybe it's lagging now, but long term they might end up outperforming the tech. That's a big if, but may outperform the tech sector. It's just they're going to make up those gains. It's just when are they going to do it is our question. So it's trying to figure out how long term are we talking on some of these trends.
I mean, that's, again, I'm not raising an objection to what you all want to do. It's your portfolio to manage, and we're just here from an advisory standpoint. But so, I mean, I just see it as you guys have had a great year in a very challenging set of circumstances in which to manage money, and you've got great results year to date. So it would be, in my mind, you know, some consideration of, you know, how do you protect the lead you've built, right? I'm not saying necessarily get defensive, but and I have no issue with your work on NVIDIA, Stephen. I thought you did a nice job. You know, I think that you are still venturing into some areas of not only excessive valuation, but really high volatility. I mean, these are really volatile stocks. So, you know, just be prepared for what could transpire if we get, you know, some of those types of events before, whether it's before year end or early next year.
For sure. Thank you, Ray.
All right, some great feedback. Do I have anybody? Some of the analysts are answering some of the questions for me. I think that's great. Drew, I think there were some questions in there that you could go back to, look at if you want to, and kind of chime in as well in the chat. We're coming up close. We got the last 5 minutes here. Anybody have any comments they want to make? Any questions for the team going forward?
Hunter, just, you know, I think, I mean, we got to keep in context that there's more than COVID, and I mean, they're all related, of course, but there's more than COVID than the election that would have an influence on how a portfolio performs. So I didn't really hear, I think, enough discussion on, you know, what the Fed announced. You know, they're you know, it's rather remarkable that you know, they're shifting to what's called average inflation, and I think that I would maybe you know, put as a task to the team that they really fully appreciate what the Fed has done in terms of, you know, how it is different from, you know, previous policy direction. So anyway, that would be something that maybe for the next ISM that they could address directly.
Sure. And Jacob, do you want to chime in real quick on our thoughts about the Fed's recent decision to keep interest rates so low?
Sure. And I remember probably at the beginning of this year, we talked a little bit about average inflation targeting, just how we knew the Fed was signaling sort of that's where they were heading. So it's something we've been thinking about, kind of anticipating, and that's how we've been thinking of everything for several months now. But again, I know that there was a question about how that impacts financials and how we move into that. So as far as inflation goes, I think some of those expectations over the next year or so are subdued. We just want to see the spending to increase, employment gains to continue before we, you know, start to really consider what inflation has with that. And again, there are really long-term impacts with keeping interest rates as low as they are for many years. So yeah, I would love to try to focus more on that on the next ISM. I did just want to kind of really focus on the COVID-19. I know we've not met since the beginning of the year and the election. I knew that would have a lot of questions there. So I'll make sure to kind of go back and recircle on that. in October.
That sounds great. If there's no other questions, no other comments, I would like to point out real quick that we have folks on a Zoom call, 2 from New York, one's out in California, one's in Maine. So this does provide us an opportunity to reach out to some folks in other areas. We got 10 young alumni back. We have 10 on the board. We have 10 professors here. So we have this worked out really well to invite a lot of people. I think the flexibility helps quite a bit. And we even have some folks like Stephen Rich and Fred Reagan that are just a longtime guest, always supporting the Smile Fund. So I just think it's really neat to see this group. We've got representatives in town from Patton Albertson Miller. We've got Acumen, we've got Patton Group, we've got Patton & Patton, we've got ACA, Unum, TVA, Solomon Wood. We have a lot of folks in town here, and I want to thank all of our guests for coming on. I want to thank everybody for the great feedback. This is what makes the Smile Fund special. We really do appreciate it, and we work very hard because we know that you care about this fund as well, and we just want to thank you for your efforts and for your participation. All right, anybody else?
Very well done, Hunter and team. I think this was a particularly good ISM. Well done.
All right, fantastic, guys, fantastic. Great job, everybody. You know, we don't have a way to maybe congregate as well as we did in the past, but we're going to find a way to reward you guys. The next one is October 29th at 11 a.m. as well, so go ahead and put that on your calendar if you don't have it, and we'll get you the Zoom links and everything as well. So thank you all for coming. Until next time, appreciate it.